Hi everyone, this is Matt with the Fundamental Investing Institute. Welcome to Fundamentals Unfiltered. Today is Tuesday, October 21st, 2025. So I want to start with a couple of articles. One is they're both long form articles. One was in the Financial Times. One was in the Wall Street Journal. The article that was in the Financial Times is actually from earlier in the month. But what it's documenting is how the AI ecosystem is becoming increasingly intertwined financially, and this is especially the case with OpenAI. So we've had a lot in the news showing, Nvidia is now putting money into OpenAI with these buyback agreements. So OpenAI is agreeing to buy chips as Nvidia is putting money into the company. And they have other relationships, one with chipmaker AMD, also Oracle, a few others. And I think it's about $1 trillion in committed capital that is going into OpenAI. But the point of the article is to sort of highlight how much the AI ecosystem is becoming interconnected financially, and that's not so much a big deal if all of the AI expenditures on data centers and everything else are just being financed out of the deep pockets of a lot of these tech companies. The problem is when it starts to bleed into the debt market. So when we start to see borrowed money coming into this to fund data centers and other things, that's where things can get, frankly, a little hairy. And one of the venture capitalists that's quoted in this is making that point. So with a lot of the data centers, the way they're financed with the use of debt is they're using what are called special purpose vehicles. And these are entities that are created to hold a specific asset and to hold the debt of a specific asset. And they're generally structured to be off balance sheet. So there's not a lot of disclosure on them. And they're usually what are called bankruptcy remote, or they are isolated from the other assets of the parent companies. So if these data centers are not producing the cash flows necessary to cover the debt, and this is probably years down the road, but if that happens, you could see some real hiccups in credit markets. And this will get into something that I'm going to talk about in a little bit, about how, at least in modern times, the real hiccups, the real sources of financial panics, to the extent that they bleed into the broader economy, come from credit markets, not equity markets. And I'll bring that up because I'm going to talk a little bit at the end of this video about the 29 crash. Now, the Wall Street Journal article talks a little bit more about Sam Altman, who's the founder of OpenAI, and his deal making that's been going on in the last few years, where he's been courting a lot of these tech companies to try to put money into OpenAI and into AI infrastructure. And one noted thing in this article is that he had told his employees at OpenAI that OpenAI's goal is to build 250 gigawatts of computing capacity by 2033, so less than 10 years. That amounts to about a $10 trillion investment in today's dollars, 10 trillion with a T, and that's enough power to cover a country the size of Germany, according to the article. So it's a massive, massive bet that's being made on AI infrastructure. And I think I mentioned this in last week's video, that a larger and larger portion of the economy is being contingent on AI spending. It's sort of becoming one big bet on AI. I mean, there's other parts of the economy that are doing well, but there's really a disproportionate bet here. Now, another figure, OpenAI is doing 13 billion, or is expected to do 13 billion in revenue this year. The commitments from Nvidia and Oracle alone are 650 billion. So this is what they're committed to buy from these companies in terms of chips and other resources. So 50 times current revenue just from the commitment of these two companies. It's many times revenue, many more times that as a multiple of revenue if we look at all the commitments. And OpenAI is making even more commitments. We have other AI companies such as Anthropic. They're kind of doing the same thing. So this is something that we want to keep an eye on, because as more and more AI expenditure gets into the debt markets, you essentially have one big concentrated bet, and all of these companies are interconnected. So any one, weakness in any one part of this interconnected financial ecosystem could bleed over into others. So that's something that I think that we should all pay attention to through the financial news in the coming months, coming years. I want to talk about gold prices a little bit too. Last week I reported that gold had broke $4,100 an ounce, which was incredible. And I was really raising the concern that this was just becoming a momentum trade. A lot of the risks that gold is supposed to hedge are not being seen in other markets like debt markets. This week, the price, at least as of yesterday's close, it's nearing $4,400 an ounce. So gold is just continuing on this tear. I'm convinced even more than last week that it's mostly a momentum trade. That doesn't mean that there's not, if you want to trade on momentum, go ahead. I'm not touching it personally. Something I want to draw attention to, there was an editorial in the Financial Times this week. It's a global money manager named Ruchir Sharma, titled "Why Gold and Stocks Are Partying Together." So essentially what he's highlighting is that historically, and by I say historically, I mean going back to the 1970s, because gold really there wasn't really a market for gold before 1971, because gold was still anchoring the global monetary system at a fixed price. So when the United States went off of gold in August 71, and really in the few years after that, gold started to trade, and it really went on a tear. So historically, going back to the early 1970s, gold has not been correlated with stocks. It hasn't been negatively correlated, but it's not been correlated with stocks. So what this money manager is doing in this editorial is he's showing that when gold historically went through its most aggressive period, in terms of when the price was the highest, was in the late 1970s, when it was being bought, when we had a massive wave of global inflation, particularly in the United States, and it was being bought as a very clear hedge. Now, gold prices crashed in the early 80s when Paul Volcker was tightening the money supply and inflation was brought under control. But in the late 70s, gold was on a tear and stocks were heavily depressed. If you go to the late 90s, you really had the exact opposite, which is stocks were on a tear in the internet and telecom bubbles. Stocks were on a tear in the late 90s. Gold prices were depressed. So in that sense, there was some negative correlation, but throughout that period, there wasn't much correlation. Now there's a lot of price momentum both to stocks and gold prices, and that goes with other asset classes as well. And what this money manager is arguing in this editorial is that you still have a lot of the liquidity that was introduced in the global economy by central banks during the pandemic a few years ago. And he cites, I think, $7.5 trillion in money market mutual funds. So that's evidence of a lot of liquidity. But to him, this is a liquidity-based momentum trade. One of the things he cites is you've really seen a move in terms of gold buying. You've really seen a move from global central banks over to retail ETFs, exchange traded funds. And I think he said it was up ninefold. The share of gold buying done by ETFs is up ninefold on the year. So that convinces me even more that this is a momentum trade. ETFs are being largely bought by retail investors, and I think they're just trading on that momentum. Hey, maybe there's money to be made again. One thing to consider, though, that that this money manager brings up, the author of this editorial, is that if they're correlated to the upside, they could very well be correlated to the downside. So you could see weakness in stocks or weakness in gold impact each other on the way down. Something that people in this market probably want to consider. Now, I do want to bring attention to a special report from the Economist, just so we don't ignore some of the risks that gold prices might be hedging. This is called the Coming Debt Emergency. It's a special report, and it's a series of articles that really talk about sovereign debt, so government debt in the industrialized world. And here in the U.S., debt to GDP ratios are the highest that they've been outside of wartime, but this is going on in other industrialized countries as well. So a couple of statistics that this report brings up. Public debt is a share of GDP. GDP is total economic output, stands for gross domestic product. Gross public debt as a percentage of GDP is nearing 110%. So this is close to an all-time high. The average deficit, so the deficit is the difference between government expenditures and government receipts, mostly tax receipts, right? So we're in deficit when expenditures exceed receipts, and you're in surplus when receipts exceed deficits. Not had surpluses in most of these countries in a long time. The average deficit in the advanced economies is going to be over 4% of GDP this year. In the US, it's over 6% of GDP. So you have these massive deficits that bond markets are likely going to react to at some point. And one of the things that this report brings up is that lacking the political will to introduce austerity to try to bring the debt to GDP ratio down, to try to bring the deficits under control. And again, this is throughout the industrialized world. Absent the political will to do anything about it, governments are likely going to rely on their central banks and inflate the money supply, and that reduces the real value of the debt. It becomes a kind of a default without a default, but I shouldn't have to tell anyone why inflation is bad. We've just lived through the highest inflation in the last 40 years. So if that happens, then we could see, you could see late 1970s type conditions throughout the industrialized world. Hopefully it doesn't. Hopefully governments get their acts together and start to introduce some real reforms on the tax and spending side of things. But absent that, future inflation is a real risk that are not being seen yet in bond markets, and gold prices could be largely reflecting that expectation. It's a real possibility that I wanted to bring up. Now, the final thing, as I mentioned last week, when I do my little review or commentary on what I'm reading, I mentioned Andrew Ross Sorkin's book 1929, which, when I mentioned this last week, I had pre-ordered it through Amazon, and it was coming in the mail. I received it shortly after we recorded the video. I'm in the middle of some big reading projects right now, so I didn't have a chance to do much more than thumb through the book, skim through it. I had read Andrew Ross Sorkin's first book. It's a chronicle of the collapse of Lehman Brothers and the onset of the financial crisis. It's a wonderful book. Andrew Ross Sorkin is a very good journalist, and he's a master storyteller. So I can already tell that this book is going to be a great addition to the literature on the 29 crash. And I say this as someone who's been studying the 29 crash and the Great Depression for a long time. Now, what I want to comment on is Sorkin's been on a lot of different podcasts, and he has been on, I think he was on 60 Minutes, some different shows. Sorkin was being asked, I think it's an understandable question, what are the parallels between the stock market of the late 1920s and the stock market today? And Sorkin gives some good answers about, things like artificial intelligence being kind of the new thing, and they were new technologies in the 1920s that people were very excited about, and that was helping to bid up stock prices. Um, to Sorkin's credit, he does highlight a little bit about how markets are very different today, and that's what I wanted to kind of touch on based on my own reading over the years, is I think that we need to kind of understand how markets are different then than now. So a couple of things that I wanted to highlight. First of all, in the 1920s, there were no federal securities laws. So stocks were regulated by exchanges themselves. So the New York Stock Exchange regulated those stocks that were listed, and things were pretty lightly regulated. So if someone back then wanted to buy a stock, they didn't really have information. You didn't have the kind of annual reports and quarterly reports and prospectuses that you have now. So in that sense, stocks were considered purely speculative assets because you couldn't do any research. It wasn't until the 1930s that you had the Securities Act and the Securities Exchange Act, and then you had what are called blue sky laws, which are state securities laws, that you started to have the information necessary to be able to intelligently invest in stocks. And this is where Benjamin Graham, who's kind of the intellectual father of value investing, or what you might call fundamental investing, that I follow, this is where his book, published I think in 1934, it's called Security Analysis. This is where his book is really revolutionary in the sense that you still have the mentality of the 1920s that stocks couldn't be invested in, that they were solely speculative assets. You can invest in real estate, you can invest in bonds, but stocks were purely for speculation. And I'm old enough to remember my grandparents, who came out of the Depression, very much had that mindset in terms of the stock market. So that's one thing, is the lack of federal securities laws. Another thing to keep in mind is that the stock market was tied to the banking system in ways that it is not today, or at least anywhere near the magnitude that it was then. The way this worked is that banks were very active in what's called the call money market. The call money, that term call money, simply means that loans could be called. So the banks could call the loans back. They could be called back on demand to the lender, but banks would lend to brokerage houses, and the brokerage houses would in turn lend money to the customers, and the customers would buy stock on margin. And that meant that they could buy stock by putting up a little down payment and then borrowing the rest. And in a lot of cases, they were borrowing $9 for every $1 put up, so 10% margin. Now, what happens, and in the 1920s, a greater amount of stock was being bought on margin. That's really how the bubble was being fueled, was with margin money. So if stock prices were to decline, I think you could see the circularity of this. If stock prices were to decline, brokers would have to demand more collateral from their customers. And as they demanded more collateral from their customers would have to sell stock, which further depressed stock prices, which led to more margin calls, further demands for more collateral. And so you would see this huge liquidation that would unfold. So that was one thing, is the stock market was tied to the banking system in that sense. And what we have to keep in mind is the banking system at the time, there was no deposit insurance. So if you were a customer at a bank and you were concerned about the solvency of that bank, if you didn't pull your money out, there was a good chance you were going to lose it if the bank was in fact in trouble. So of course there was a herd mentality. People would, if they were concerned about a bank and that rumor would get out, people would en masse take their deposits out. And that collapsed the money supply as you had these financial panics. The banking panics really come in four waves in 1931 and through 1933. And these banking panics could have been dealt with by the Federal Reserve. But the Federal Reserve at the time, it was structured very different than it is today. First thing is, they didn't really understand their lender of last resort responsibilities. There was no leadership because of the structure. It was unclear. Essentially, you had the different reserve banks all sort of going in different directions. The man that provided the most leadership throughout the 1920s was the head of Federal Reserve Bank of New York named Benjamin Strong. But Strong died in 1928. So there was a lot of speculation even today among economists that maybe had Benjamin Strong lived, that the Federal Reserve would have been more active. So something like that, if there's even a whiff of that kind of a panic today, the Federal Reserve would step in and they wouldn't even have to put in money. They would just say that they're willing to put in money, and that generally stops a panic. So that happened in the '87 stock market crash, for example, where the Federal Reserve just announced their willingness to intervene, and that kind of stopped the panic. But back then, they didn't do so. So you had a huge collapse in the money supply that depressed incomes, it depressed asset values, and it spiraled. And you didn't really see a bottom to this until the spring of 1933, when you started to see some monetary reforms. The U.S. got off the gold standard, and there were a lot of other monetary reforms. But I just wanted to highlight, because I thought it was interesting. Sorkin was being asked a lot of these questions about, what are the parallels then and now? And of course, in a lot of these videos, Sorkin doesn't really have a chance to get into it in any big way. But it's interesting with Sorkin having studied both the financial crisis, the more recent financial crisis, and then the 29 crash, what those parallels are. But it's important to talk about the differences just as much. Now, I'm not suggesting that a broad financial crisis is ever off the table. Having lived through the 2008-2009 financial crisis and then the pandemic, certainly the idea of a financial crisis is not off the table. But I think it's important to know that these things are likely to happen in credit markets, and particularly short-term credit markets. So I highlighted some of that risk earlier in the video, but there are certainly other risks as well. So we always want to pay attention to what's happening in credit markets, because there's a saying that generals always fight the last war, and I think regulators and investors and market participants always kind of think about the last financial crisis. And of course, we don't really have enough imagination to think about where the risks might be in terms of the possibility of the next financial crisis. So it's always something that we have to keep in mind. That's enough for today. I want to wish everybody the best week possible in your investment endeavors. And as always, focus on the fundamentals. We'll talk to everybody later.